Welcome to another video, another stock analysis. This time it's gonna be, drumroll please. It's gonna be, and you would have never guessed it, not even by looking at the thumbnail, it's Microsoft. Wow. I know. Did you expect that? No? Did you expect that? No? You didn't either, right? I thought so. So let's get into it. First of all, the business model. The question we're always asking ourselves in this segment of the video: how does the company milk us? How do they make money from us? And the answer is Microsoft sells Microsoft Office products. Fairly simple, but apart from PowerPoint, Excel, Outlook, etc., Microsoft 365, whatever they call it at the moment, they also have other things. For example, gaming, which includes the Xbox, and they're about to buy Activision Blizzard for $68 billion US, but they're still facing some antitrust issues in some countries, especially Sony. I don't know why Sony would be against it, but Sony is against it. They don't want Xbox or Microsoft to sell Xbox exclusive games, and I can't imagine that they would do something that hard to Sony and the whole gaming industry. But yeah, that's why they're against it. And they also sell hardware. And hardware includes their laptops, for example, the Surface laptop. I honestly only used it once, like 5 years ago or so. But yeah, I'm an Apple guy, so sorry, Microsoft. Additionally, Microsoft also has LinkedIn. And oh boy, I really love LinkedIn. It's become sort of hilarious in the last few years because all of these people who have these humbling stories about how they advanced their career, love to read it. It always makes me feel so cringe. Additionally, they also have GitHub, which is a developer tool. And of course, they have their cloud services, which is named Azure. And that's a pretty interesting thing because it's still growing massively and it's actually their biggest revenue segment. And then we have the holy grail of Microsoft, or maybe it's gonna become the holy grail, Bing. Who would have thought that Bing would get the chance to have such a huge revival after they introduced ChatGPT or OpenAI's chatbot into Bing? And actually Microsoft is striving to put this AI into different products. For example, Azure, and I believe they might also put it into things like their Xbox or their Microsoft Office products, which would be a really good thing for them. And I really like that they invested so much money in OpenAI and they're still continuing to invest even more. So overall, I believe that Microsoft has a really good business. They have a lot of different segments that are still growing, and that's really sexy. So that turns me on a little bit. But let's jump into the financial in step number 2. First of all, let's look at the P ratio, which is at 27.71. And the forward P is only 26.67. But still, even though it's not expected that they will have huge growth in the next year, I still think that they actually will have a bigger growth than that forward PE would predict. And then one interesting thing, and where they really stand out against their peers, is their return on equity, which is 39%. And I'm no mathematician, but their peers, so other computer software companies, only have a return on equity of 12.5%. That's the industry average. And I believe that 12.5% is much lower than 39%, but that's my opinion. Now let's look at their balance sheet. And oh boy, I don't think it gets any more healthier than that. I think it's even healthier to just look at that balance sheet instead of eating broccoli or any other kind of vegetable, because they have such a good financial position. Their current assets are 170 billion, which is a lot, and their total liabilities only are at 198 billion. So it's only a difference of 28 billion between total current assets and total liabilities. Not current liabilities, but total liabilities. So they have a motherload of money and current assets, which they can utilize to either invest in new projects or even pay off debt if they wanted. And that's what makes it so healthy for me, in my eyes. And for those who are looking to get some dividend income, that's also a good company to invest in for you. Because they have a dividend yield of 1%. Ha! 1%. So much. And the good thing about it is they only have a payout ratio of 28%. So there's a lot of room to grow, and they're still growing their business in general. So payout ratio can be increased, and revenue and income is still increasing. So that's a good chance for dividend investors to buy the company for the long run. And now let's hop into the DCF model. Let's go. Wow, how did I get here so fast into my DCF model? I'm a magician, or someone else is playing with me like a ball. So anyway, let's get started into the DCF model. The company is currently worth 1.9 trillion US dollars, and they have 7.44 billion shares outstanding at the moment, which results in a current stock price of 255.55 cents, which sounds like a terrible number to pronounce. And it is, I can confirm. Let's take a deep dive in some of my assumptions. We will have a more difficult environment to do business in the next 2 years because of, guys, I'm a fan, not a fan, but I think that a recession is about to hit us in the next few months. And I think it's going to be more difficult to operate in the next 2 years because of that. Stop honking, guys. But then afterwards, it's going to recover back to 14% before it's going to eventually gradually rewind back to 10% and then respectively 7%. I think the cost of revenue will also increase pretty close to the increase in revenue because of inflation and everything that is going on that comes with it. But I expect them to increase their gross margins in the next few years. Also, the SG&A and R&D segments, I really hope that they will continue to invest money because you can see what happens. They now have a far superior AI in their search engine. So in comparison to Google, they are a step ahead, even though they might not have the market share at the moment. But if Google doesn't fix their problem with their Bard program or software, they might catch up in the future. So that's a good thing. Keep investing, guys. And that's also true for Microsoft, even though they're a big company. And then also, same as for Apple, I do believe they will decrease their debt because of the rising interest rates. And they will pick up that money later again. So it's just a temporary thing that they will offload debt and take it back on later when interest rates will be lower again. And then again, 2% eternal growth rate, and then a 15% cost of capital, which is my cost of capital, and I expect my companies that I invest in to have a return of about 15%. And the risk-free rate, which are the 20-year US Treasuries, are at 4.19%. And whoever is interested in the technical stuff of my DCF model, you can look at my flow to equity table or chart. Yeah, it's a table, but I will jump right into the outcome. My fair valuation of Microsoft is 1.78 trillion US dollars compared to 1.9 trillion. So again, math, 1.78 is lower than 1.9. So I believe the company is overvalued at the moment. Not by far, but a little bit. And if you calculate that into the share price, it's better visible because the current share price, as mentioned before, is 255.55, and my fair value is 239 and also 55 cents. I don't know what's up with the 55 cents. So at the moment, I wouldn't consider buying Microsoft by just looking at my DCF model. And let's take a look at the chart to figure out if we can actually get Microsoft at that price or if we have other price action going on leading to other strategies that we might be able to implement. Hop! Don't worry about me, I'm okay, even though I had to switch side on to the other side of the screen. But yeah, let's take a look at the chart of Microsoft. As you can see right here, they had a stellar, and I really mean stellar rise in the last few years. However, that upward trend ended, it was exactly December 31st of 2021. So all of 2022 is this downward momentum that we see right here. And I implemented a trend line that we are currently also looking at right now, which is really interesting. And we also have the 200-day moving average almost at the same position. So this point is actually crucial for Microsoft, as this can decide whether we will pop up over the trend and might even break the trend finally after this fake out right here, or if we will trade lower again. And I don't think that this Fibonacci retracement line right here would really hold, and if they would move down again, they could potentially go down back to 215, but I think a reasonable range for them to buy would be between 225 and 215. But all of these ranges and things, these are my personal opinions, so please invest time yourself to figure out if that's the right decision for you. Not for me, because I'm making the video, but for you guys. And I think that's really important to mention at this point. But if the stock goes up and not down, I believe that a range between 265 and 275 would be a reasonable range to short the stock and take some gains by betting on falling prices. So these are the two scenarios I would consider: either shorting the stock at 265 to 275 or buy the stock between 225 and 215. And that almost concludes the video. So as a summary, Microsoft has a dope business model with a lot of segments that are still growing and still going strong even in the future. Even if we have economic downturns or hardships, they will still produce good results. Secondly, they have one of the healthiest balance sheets out there. As mentioned, it's even healthier than eating vegetables or carrots or I don't care, or even multivitamin pills. Healthier than anything. Just look at the balance sheet, it looks amazing. Then we have the fair value, which I believe is at $239 US, so pretty close to the current market price. And regarding the price movement, I have two scenarios: either short the stock at 265 to 275 or go long in the stock at 215 to 225, which both would be interesting for me to consider. So hopefully this was entertaining and helpful for you, and I hope to see you guys next time in my next analysis. See you next time.